Hey guys, it's October the 28th, and wow, what a crazy market. We've got one more day after today left in the month. And so, you got to be really careful. Let me actually share my screen. This is really, it is just a really fascinating market right now. Past performance, not indicative of future returns. Today, I'm going to go through Credit Suisse, Amazon, Apple, and Exxon Mobile. But it's like very hard right now to figure out what are the best stories because there's a lot of really amazing intelligence that's coming from each of these companies and what they're saying about the macro front. I mean, it's really something special. If we look at the indices, this massive rally, that is impressive, for lack of a better way to describe it, given that Amazon, which is a huge component, was down so much. Now, I actually think that Tesla is only down because it happens to be in some of the same indices as Amazon, to be fair, because there is nothing wrong with Tesla. If anything, the big champion of mega cap right now really is Tesla. And that's despite all the crazy news flow that's going on, because they legitimately are growing and are in the right industry and are killing it. I mean, I think everybody will start to talk more about the energy piece of Tesla. It's not that people don't talk about it all the time, but I think people are so obsessed with the autos business, they might miss something that's going on there that is echoed from everything from Linda, which reported. And what Linda does is they have a piece of their business among various aspects of the chemicals piece that they do, but they do have a piece that does ammonia or urea. And that is essentially your hydrogen energy. But everything from there to Alumar, which will report next week, we shall see how they get it, all the way through to even the oil and gas companies are telling you Europe doesn't have what they need for energy. They are burning more coal. Okay, so we will go through that in just a second. But this is what the screen looks like today. There is a desire to buy like literally everything. It is really fascinating. And it's a lot to digest, but let's go through the thing that I think really took everything higher, and that is this PCE number. We did talk about the fact yesterday that after we get through these mega cap earnings, people are going to start remembering that there is this thing called economic data that's driving everything. Well, it turns out the PCE number came in great, 6.2. You can see sequentially, 0.3, you can see sequentially that you are starting to get these indices not as bad as they were. So X food and energy 5.1 versus 6.2. We still have to get food and energy down, but it's an interesting scenario that the Fed is set up with. And I think that this is kind of all over the map, the way people are thinking about it. The raising of rates, I know a lot of people are thinking, hey, it's not going to work on food and energy. And I have even said that in the past. But if you raise it sharply enough and as quickly as we have, you will get a lot of companies just backing off of spending in some ways. You will get them backing off of their growth estimates, and you'll get them just kind of working on cost cutting and not as much on like really aggressively coming at it. Now, a few companies have strategically announced that they don't care. They're actually going to take the opportunity to be strategically aggressive. And then we can see, which we've kind of talked about in mega cap land, the CapEx numbers and the R&D numbers demonstrate that these companies know that since they're not going to get full credit for what they're doing, they're just going to basically try to use the capital that they have acquired over these wonderful bull markets that have happened to try to spur future growth. And I think you see that very clearly in Amazon, strangely enough, as much as people want to be haters on it today. I absolutely got rid of my puts there. I have mixed feelings about how to feel about it going in the fourth quarter because it is still a fourth quarter game, but we'll get into that in just a second. Now, next week's earnings, before I do go into the individual names, you can kind of see there's still a lot of earnings to come, but it's not the mega cap names. And so it'll be a very interesting thing that happens. We will get some more semiconductor intelligence next week. You'll get a lot of consumer, and that's not going to be the prettiest thing out there, especially given that we also have the FOMC announcement on Wednesday. So you do want to be very careful. If you're a day trader, just keep that in the back of your head. If you're a long-term investor, be open to the possibility that you get a shot next week. Again, as these things kind of just dance around and get traded in front of the FOMC meeting and in front of some earnings that could be really all over the map, because that's what it's looked at. You really do have differentiation, but I am shocked that I've listened to about 120, 125 earnings reports thus far, and we still have more than 50% of the companies very clearly growing earnings and growing revenue. A huge component of that, and that's despite the fact that we still don't have all of oil and gas having reported yet, which I anticipated would do extremely well. Okay, MGM, a couple call outs. First of all, BP, which is not in the S&P 500, I will be watching that carefully, because the real question is what's going on in European oil production. BP is going to be one of the bigger producers. Royal Dutch is the other one. But we'll be watching that next week. Exxon Mobile kind of already told you some stuff associated with that, as did Hess earlier this week. And then the other one that I really want you guys to watch, because it's very misunderstood, is MGM, okay? I have long positions on Baba. My positions are farther in January. I've got 2 YouTube videos at this point on how to think about the CCP National Conference and how it's been reported versus what I think actually matters. Okay, that is what it is. But what I would say is that China, if it does reopen, as I've mentioned before, will probably do so, not here, let me stop share for a second. If China reopens, it's not going to do so at the CCP National Con. It's not going to announce that it did anything wrong. That's just not how leadership works. Let's just call it what it is, right? What leader on this earth has said ever upon being reaffirmed that I made massive mistakes? He's just not going to do it. But the first place that we could see them safely and reasonably giving you a heads up as to what's going to happen, if they are going to, or if they're not going to, and the timing of where they're going to do it, is actually MGM. And the reason it's MGM is because they could actually open up Macau in a way that is a little bit better. And also, they could potentially start to allow the greater China region to have a bit more travel. That's what I foresee would be the first initial step. So that's what I'm looking for in MGM. Regardless, MGM actually did really well last quarter and got 0 credit for it. So MGM's legitimately cheap is what I'm saying. So have a look at that one. That would be a lottery ticket play. The other lottery ticket play for next week is CF Industries. CF Industries does nitrogen for fertilizer primarily, although they do some industrial fertilizer, what have you. Because Lynn came out really strong on what they said was happening in that marketplace due to blue hydrogen, et cetera, and the need for that kind of fuel, I think that puts pressure in general. They also said that they're not yet seeing China come back in and supply nitrogen broadly. That's always going to be the wild card in the nitrogen business. You can see it very clearly in every company's disclosures. They definitely, for whatever reason, do not export nitrogen, despite the fact that they do have capacity to do so. So just realize that CF is a lottery ticket play. It is so cheap. It trades at 4 times enterprise value to EBITDA. And that's despite the fact that it will probably do extremely well, at least for the next few quarters, until we get real solid indications that China is going to actually start exporting nitrogen again, because I don't think people are going to accept nitrogen from, conflict regions, if you will. Okay, so that is just a preview of lottery tickets for next week. Or if you're a day trader, have fun. I love to see you guys make money. I think everybody with their investment style should make whatever money they can make. Okay, so now let's talk about, I'm going to talk about Credit Suisse first. I know you guys really only care about Apple and Amazon, because those are the easier US ones. But I really want to encourage people to pay attention to what's going on in Switzerland, because this CEO, Ulrich Koenig, I'm sorry if I pronounced your German name incorrectly. I've never been good with Germanic names and Germanic languages in general. This guy, if he pulls it off, he deserves like probably CEO of the decade, because what he's going to do, let me set up this story for you so you actually can follow along. This has been going on. First of all, the Credit Suisse issue has been going on since Archegos blew up in a blaze of glory and took basically the prime business out, as well as there's a number of different other things that happened in the fixed income markets, of which Credit Suisse unfortunately had the bag, for lack of a better way to describe it. So the Credit Suisse situation is not new, but I think it is hard to follow if you're not very knowledgeable about the banking system in general. And that really, what's been happening is essentially a wind down of Credit Suisse. And it's really, really important to all systemic finance right now. It is actually a systemic thing to watch, that it gets wound down gently and pleasantly because of where Switzerland sits within the banking system. Now, I have a whole video on that as well on YouTube. Check it out if you're following along, because I actually think he's now got, whereas I was like 40, 60, this thing blows up in a blaze of glory. Now I'm more like 55, 45 that he's actually able to get it through. I don't know if I'm yet ready to buy calls on it. The stock is $4, but what I want you to really understand here is that the market cap is showing on, I think it's probably missing a couple of share classes, but approximately the market cap of Credit Suisse, which is a major global bank, is about the same size as Robinhood. And that's what makes, I think, this story of Credit Suisse really fun. Now let's go through what actually happened on the quarter to help you guys follow along, because I do think that this one's going to be a fun one for the day traders eventually. Right now at $3 to $4, it may not be quite as exciting, but it, you know, since if you've got low capital and that's your deal, let's try to get you up to speed on it. This right here came straight from their deck. And I just, you look, there's a lot of companies too that are reporting. So I'm just going to pull stuff straight from the deck and not try to get too clever these days, because I'm a one lady show in making this presentation every day. But this is basically, sorry, this is the money shot. This is really fantastic. Whoever made the deck for this quarter on Credit Suisse, thank you as an investor. That was really easy to follow. But these are the different businesses that they have, okay? The Swiss bank, that one we got to protect, because essentially that, you know, and Switzerland has been doing things like demanding increase in reserves, stuff like that. Okay, the asset management business, that's basically what you think of as asset management classic, right? That they've sold off huge pieces of that, all funds, et cetera, these mutual fund companies for which they had large stakes in. The wealth management business is your ultra high net worth. That's your wealthy Swiss folks, essentially, right? And that business is still bleeding assets. Like they still are losing capital in that business. Corporate, that's just corporate, that's fine. And then investment banking. And what I want for some of you, this is your first time watching any kind of systemic risk banking big player get wound down, because I know there are people watching that were not old enough to be trading, although sometimes now there's some really young traders, in 2008. But the investment banking business, which contains capital markets, it contains, I'll show you in a second, everything it contains. When things go poorly, that thing can actually lose enough money to take down the rest of your entire organization. That's what these businesses actually are. And the other thing that these businesses actually are, it's something that Goldman Sachs always says. If you're an employee of Goldman Sachs, this is like one of several mottos that they teach you from the minute you walk through the door. And that is, our assets are our people. There really is nothing else a bank has but its people. All of its fixed assets are like mostly cash. That's what book value, that's why I always say like most of book value is cash, okay, in any of these banks. Okay, but every other piece of the business is just people. And this poor guy, if he can get it, he's got to shed head count like crazy. Like if you listen to the call, the thing that it's like very clear that what everybody was really trying to get intelligence on is who's getting fired and where are they going, okay? Because the asset managed business and the private wealth business, those assets, do they belong to Credit Suisse? Yes, they do. But do they follow the relationship that brought them to Credit Suisse? Also, yes, they do. So it was just the most fascinating call if you ever have been in this business, because most of the questions surrounded, so you announced how many people were coming out of the Swiss system. which they then answered, yeah, we got to do that because, we're a Swiss bank and we did that because that's been requested probably by the Swiss government, quite frankly, but it is so that they just kind of avoid any kind of issues going on there. But then people were like, are you firing people out of the UK? Like how much of that headcount is coming out of the UK? But it is a big headcount that they're still going to wind down. Additionally, they're still going to have to eliminate $2 billion in costs. Right. Okay. So that's why I'm saying the odds aren't like 75-25. They actually navigate this like champs. It's still 55-45 in my mind, because when you start to lose headcount like that, and when you start to have issues paying people, people leave. And like I said, your assets are your people in a bank, and they literally can walk out the door. And that's what the call was. That was a huge component of the call. Okay, let's actually talk about the investment bank. Not great, but the part that is really interesting to me is the fixed income business, because the fixed income business is continuing to be wound down 32%. Now, if you compare this to JP Morgan, Goldman Sachs, Morgan Stanley, fixed income was the only piece that made them money within these numbers. I mean, a little bit advisory, but really it's this. And that is why they're trying to basically wind down this business enough, spin it out, and then protect these portions of the business. That's actually what's going to happen. But he's got to keep winding, for lack of a better way to describe it. And if he does it, great job, like CEO of the year, because you will have actually not just saved Switzerland, but probably all of Europe from massive systemic risk. Awesome. But that's kind of what's going on there. The CET capital ratios, you got to give him credit, but he did make kind of, in my opinion, a little bit of a strange move. CET capital ratios have actually gone down for every single investment bank this quarter. He actually re-upped with $4 billion in capital raised. That came from PIMCO. That came from Apollo Group, two private equity firms. That's somewhat normal. We kind of saw that in 2008. And then it came from this Saudi family. And then people literally just kept pinging him with questions about where are you getting money from? Where are you getting the money from? That's always fun to listen to. So hopefully if you've never listened to this call, it's the strategy component. He split the call in two. Maybe that'll help you to listen to those two calls. But the fact that he felt he needed to re-up the CET capital ratio is an issue. Now, the portion of fixed income that they sit the strongest in, I mean, they're known, I'm right now in Mountain View with my dear friend that is big time fixed income. And we had this very long conversation. They were and have been historically very strong within fixed income, specifically structured finance. He told us last quarter that he wants to protect that piece of the business. I kind of get why he feels that way, because that gives you the biggest upside if they're able to come out of this like champs. He's got to unfortunately probably get rid of that business, but then it does lend itself to like, what is all of this re-upping the CET capital ratio all about? For the record, Wells Fargo, which has a little less exposure to certain things, is at 10%, just to give you a sense for how much more he's buffering. Okay, so full props to him. Very ugly quarter, but definitely watch that, keep that on your radar screen, because at some point, if he's able to come around the corner on this, it could be really good. Now let's talk about Amazon. It was a bad quarter. I don't think it was as bad as people made it out to be, but fair and square. Do you know what I mean? Like I said, it could easily dip below 105. It dipped, for lack of a better way to describe it. Am I ready to give it full props? Here's the thing. The reason I'm saying it's not as bad as the reaction is because he told us that the third quarter was still not going to be enough to get him through it. He said that you would start to see some improvements in the third quarter. Well, let's take a look. Okay, did he get the product sales up? Yes, he did. Okay, did he get the challenge though, however, and the reason that people don't care that this was actually a little better than expected is because AWS is starting to show operating margin compression. I'm going to show that in a second. You can see that the technology spend is up aggressively, and it massively compressed operating income in general as a result of that. And then you do have a little bit more spend in sales and marketing. Am I okay with that? Am I not okay with that? I don't know, to be honest. So it's bad, but it's actually what I would have anticipated, because I wasn't expecting back to school to save their retail business this quarter. Okay, the other thing that you're seeing, this actually was what I anticipated, which is free cash flow still down aggressively, but improvement from the second quarter. That's why I'm saying that's what he said you would start to see. That's why I'm saying it probably doesn't deserve to be beaten up quite as much, 105 maybe, but here below. That doesn't matter though, because the tide has turned and that's how people feel about it. Here's what sales looks like. Now realize that this was actually a little better on the US front than last quarter. So quarter over quarter is a little better, but nonetheless, it looks like hell relative to last year. And that's despite the fact that you do have some operating costs on specifically the retailing side in the US improving, namely freight charges. But you're kind of seeing that a little bit here. Here in the international front, it still continues to be really bad. And then this operating income number, this margin compression is where people got very upset with Amazon. So still taking an L, and we shall see how this looks in the fourth quarter during holiday season. I mean, I think that the holiday season doesn't look as good as people would like it to look. We shall see though, my goodness, we shall see. All right, Apple. Here's Apple. Revenue's up 8.1%, gross margins up 8.3, meaning that they're actually able to get pricing through just fine. Operating income up 4.6%. That's not great, to be fair, but it's not bad either. Net income was flat. Okay, so to me, FX, you want to blame FX. We certainly don't blame FX on the upside, so I have mixed feelings about that. Plus, you're perfectly capable of hedging like everybody else. EPS up 3.2% on the share buyback. Is that good? I don't know. I'm not thinking that that's great. But here's the thing. Do I ever get mad at Apple? No, I don't. Do I think Apple is undervalued? It's probably where it should be after today, but there's if you've got to do portfolio management, portfolio allocation, do you take money from 3 companies that definitely have to kind of grow a little bit in the next quarters? Yeah, I think you do asset allocate away from things like Facebook, Meta, sorry, I know you changed your name, but I do think you asset allocate slightly from Meta, from Amazon, which both have to prove themselves next quarter, to something like Apple, just to kind of have safety in what's going on with your money. Here's the mix. You can kind of see that the strength was broad across geographies. I was actually shocked at how strong it was in Europe. And so that one I have to digest personally. That kind of is what it is. So that's it on Apple for what I have prepared there. Exxon, finally, as you guys know, I have to focus on oil and gas because I've absolutely, unfortunately, been recorded over and over again telling you how bullish, or maybe fortunately, how bullish I am on oil and gas. And I continue to be bullish on oil and gas. This was a decent quarter. The numbers, why aren't these numbers, if you're kind of still coming into this space, why aren't these numbers even stronger given Exxon Mobile is the large cap in this name? And it really has to do with mix. There were a couple of real gems in this quarter. You can see that, the operating margins are improving because that's just the nature of what's going on right now. They are able to do great on the top line, bring it through, lower their debt cost, et cetera, et cetera, et cetera, which is what you'd expect them to do. But just remember that the large integrateds do actually have this business, the chemicals business. And what is the chemicals business? It basically has a number of components, the biggest of which is PVC. So they make pipes for your house. And we know from Lennar, that's already reported, and Pulte, I believe, already reported, I might have talked about them last week, you can take a look, that they're all able to do really, really well on earnings, namely because raw material costs have come down. PVC, obviously one of them. We're also seeing that echoed, lumber, steel, et cetera. So that's what this business is. And you can kind of see that it's really corrected aggressively on margins. Okay? The pricing is still up, but the margin that they're able to get off of it is much lower. And that has to do with lower demand, okay? So as much as I get that technically interest rates increasing can't lower demand in food and energy, it can actually lower demand in construction, which is kind of important right this minute because we do still have $1 trillion worth of infrastructure bill that really starting to show its little head next year, okay? And we see that echoed in CAT United Rentals is still going to come out and talk to us about what they see. The only reason that Cat was muted in what it wanted to say about next year is because of global, not US. Okay, just FYI, for those of you that also have smaller cap names that have more US exposure than international exposure. Refining margins, okay? This is crazy good. This is the historic in blue, the 10-year range, and this is where we're at. Was it as good as last quarter? Not quite, but is it still off the charts good? Yes, it is. As you guys know, we have been very bullish. Econ Enterprises, we continue to be bullish, Mr. Econ, because I'm telling you, it's the refiner that's actually paying that dividend. There's not going to be a problem, okay? And so we can see that from Valero. Next week, we've got Marathon reporting that they split out the refining business from the exploration business. And then now the Marathon gas stations belong like totally elsewhere. So that's not even their business, FYI. Nat gas margins, actually just have a look at this. That as an oil product is still off the charts. It is more than compensating for the fact that oil itself has come in significantly, which you can see it's still at the high end of its 10-year range. So that is the intelligence that we got from Exxon Mobile. And if we were unclear, I still have to listen to the call, but I took a look at Pioneer's earnings report this morning, which was stellar. They're issuing a $5 dividend per share, which is 2% that you get not over the course of the year. It's a special dividend. You get it in December. Its dividend yield is already 7%. So just do the math, okay? Pioneer traded down. So if you just want the dividend yield because you're like, I can't anymore this year, it's driving me crazy, go ahead. Onshore drilling, onshore US drilling in that Texas region is going to be fine. The other names that of course we love, Devon Energy should report just fine. And I actually really like Murphy and Matador and small cap land. I'm still making my way through some of the small cap names, but those two should do fine. Coterra, ticker CTRA, should do fine. All of these guys start to report next week. Oh, one other thing I'll just show you. Here you can see refining capacity. This one was another piece of intelligence that really tells you the problem in Europe more than anything. They're just, politics is a B star TCH, okay? I really don't know another way to say it. They probably will not get through the things they need to get through, according to Exxon Mobile. Some of the stuff that they need on the refining side, it's just not looking good for them. That's what Exxon Mobile had to say about it. And with that, I will stop sharing. Hopefully all of that made sense. I know this is a little bit longer than usual. Any questions?
May, very good, very thorough. Amazon, I mean, the earnings multiple is 90.
I know.
What's going to grow? Yeah. What's going to grow? Is cloud going to grow that much? Cloud seems to be shrinking.
Okay, here's the thing. Gosh, if he can fix that retail business, I don't see, it's not so much the cloud is shrinking as that the margins weren't great this quarter. And the margins aren't great this quarter because I feel like most of the space, with the exception of Microsoft, but maybe Microsoft in the fourth quarter will do something a little different to set up the year. But most of it's R&D that people are spending on since they're not getting credit for this year. And that is the right call, in my opinion. So you will have margin compression for the near term, but it's not quite fair to say that the cloud business isn't growing. It's still growing at a like 28% this quarter. And that's despite the desire of the world to slow down GDP growth.
Gotcha. Now,
so the one data point that you can see that kind of offsets that is when you look at the data center guys, where these things actually have to sit for you to continue to grow server capacity, for you to continue to take in this data that's going to drive the Internet of Things. So what is the Internet of Things? Just in case I don't want too much jargon in these, because I know people might be watching this at all different parts of their learning curve. The Internet of Things means that your devices are going to shoot up a ton of data, allowing any number of things that people are going to want to do with it. that obviously has autonomous vehicle implications, that has implications to all the data that everyone's collecting off of us, that has implications to the spend that everybody's talking about in AI. And it also, by the way, has implications for any improvement in graphics, such as what we're going to do in 3D space. Okay, so all of that is what's driving data, period. And the real question is it a slowdown right now because of what's going on with global growth, or is it truly a problem? Okay. And so as relates to AWS, as relates to what's going on there in that piece of the business, I think it might be a blip for the next 2 quarters before we start, moving up. That's why, I can't be too negative on AWS and on Amazon. That's all. Sorry, that was really a long response to a very simple question, David. It's timing, though. I'll give you time.
You've done so well, and we've done so well shorting Amazon. And how does
we really have. Despite all of that.
How does he fix retail?
What's that?
How do they fix retail?
Okay.
Exactly. Thank you.
The number one thing that will fix the retail business is China opening up at this point.
So they get products cheaper? What?
Yeah. So if China opens back up, right, it will actually, gosh, I almost feel silly because it's such a series of knock-on effects. If this, right? But if China opens back up, it may give you a little bit of pressure alleviation off of Europe, namely, it's really coal imports and fertilizer imports that they might get from China if China decides they feel like doing it. Now, China hasn't been exporting fertilizer for a while, so there is that. As relates to coal, it sounds to me like even though Europe is burning more of it, very clearly from what Exxon had to say, as well as a few others, very gently suggested that, because it's very faux pas, I think, these days to talk about it. The fact is that would actually help them through the winter, despite the fact that they've eliminated a lot of utilities, facilities that would be able to burn it and produce it, et cetera. But nonetheless, correct. But if you get that inflation, subsiding a bit, then you could actually start to see global monetary easing.
You're playing a lot of cards.
I know. You're so that's why I prefaced it with, like, I do feel a little silly saying this, but that's why I keep saying this China wild card is a real thing for the entirety of the world. They literally could help us. I don't think they do anything, and you could see that episode. I don't think they do anything until after our elections, because I think they kind of want to, like, they got to navigate a certain way right now. Do you know what I mean?
Yes. Meta, same old Meta. I don't know. 85.
Yeah, Amazon's in a little bit of a different spot than Meta in that regard, right?
Yeah, Amazon's in the real world.
Yeah, Meta. So with Amazon, we know what they have to do. They have to turn around the retailer, and then if GDP growth starts up again, they'll be fine. With Meta, you do have some business model impairment, and they haven't actually yet told you what's going to change in the new world. Google, it's just an ad spend issue for them. Nothing's impaired there, and if anything, some of the newer things they're doing with various parts of their business are going to be fantastic. And with Microsoft, they're doing great. You know what I'm saying? It's just whether or not they feel like spending more on CapEx to compete with everybody else that's now spending a lot more on CapEx. And then with Apple, if you get any kind of improvement on global GDP, they're going to do fine. So that's where everything sits right now. So Meta legitimately would be the one where I really would need to see another quarter to be like, yeah, it's time to buy.
Okay, I'm sure they're going to use the story that you're getting retail for free, that the cloud is worth 91 times.
I mean, what I've had to say about that argument.
What other company does just cloud?
I don't know. I'm trying to think, like, because every single one has a piece of business elsewhere. I feel like
Uh,
somebody else might be able to answer this question because it's going to be in mid or small cap land. Yeah.
Yeah, that's what we need to compare Amazon to.
I mean, it's a little bit hard. You could say Snowflake kind of, because technically all their businesses are in cloud. You know, cloud is such a ubiquitous word because then there's services on that, that's still considered cloud, but you know, Snowflake, I don't get I actually think Snowflake doesn't get the love it deserves personally, but
And
you know,
Snowflake is losing money.
well, Snowflake is losing money because it's piling it into R&D and sales to try to take share.
Gotcha.
And that's what I mean, it's a much earlier stage company if people really give it full credit, but they don't. So that kind of is what it is.
I mean, I think this markets back to the basics, old school stuff.
Yeah.
So, I mean, I'm not buying Amazon. I'm not buying, I mean, Apple's a good thing. It's old school.
I agree. I definitely agree with you. Like if you're a day trader, knock yourself out. These companies are going to be really fun for at least the next 2 quarters. But if you are thinking like, no, this is long-term capital, I don't have time to day trade. I actually have to go to work on the daily, or alternatively, if you've got some portion of your portfolio there are legitimately easy layups that you can do within to like set yourself up investment wise in a really beautiful way. You don't have to play these big cap names yet.
Got it. Okay.
Yeah, so I'm totally with you in that. You know, I think dividend yield is undervalued right now in a big way. That's why some of these oil and gas companies are legit giving you a lot of yield. You know,
Yeah. Yeah. Like Devon.
yeah.
Stock of the
Now Pioneer, because if you add back in this new special dividend, it's going to yield you about 10% as well.
Okay.
All
Good.
right.
Get rid of these big caps and we go higher.
Yep. Yeah, I mean, you know, I think it's a little bit earlier in big cap, in big cap tech, and I think that's what the market kind of showed you these last 2 days. You know, will there be a place for big cap tech in the next quarter or quarter after? Yeah, I think there will be, but I think you're a little bit early, and the problem with being early is how volatile this market is. You know, which means it's not like usually you're too early. It's a 5% move, maybe it's a 10% move, but it could legit, like we're saying with Amazon, if it doesn't produce numbers next quarter, it's an $80 stock. Do you know, it's in the 80s. That's like a 15, almost 20% move that you could see, which is painful, you know, for lack of a better way to describe it. It's just painful. Same thing with Meta.
Yeah. Yeah.
All right.
We're buying calls on S&P right now.
Yeah. Yeah. And I think that's what's fascinating is that the S&P was able to be up so strong despite those big cap names just getting crushed and clobbered. That is a very specific sign.
Right. Okay. Thank you.
All right. Have a great weekend. Make sure to be careful going into the FOMC meeting. Bye, guys.